Welcome to this session on hawks, doves, and vote splits. In this lesson, we're going to break down the language and internal dynamics of central banks and how they shape market expectations and trading opportunities. So what are hawks and doves? Now, central bankers can generally be grouped by their bias. Some are more concerned about inflation, others are more concerned about growth. So we call the inflation-focused policymakers hawks, and the growth-focused policymakers we call doves. Now, these biases influence their voting behaviour, public statements, and ultimately their monetary policy direction. Now, a hawk is someone who sees inflation as the biggest threat. They push for higher interest rates, tighter financial conditions, and are very quick to unwind stimulus. They may warn about overheating economies, even if job growth looks solid. Markets interpret hawkish tone as a sign that tightening is coming, that interest rate hikes are on their way. On the other hand, dovish policymakers, or doves, are more focused on supporting employment and growth. They're generally more tolerant of moderate inflation and more cautious when it comes to increasing interest rates. Doves often advocate for patience, suggesting that the risks of moving too quickly outweigh those of waiting. Markets tend to react to dovish signals by pricing in rate cuts or extended easing. Now, why does this matter for markets? This matters for markets because a hawkish central bank will often boost the local currency and pressure stock prices. Why? Because higher interest rates are on their way. A dovish central bank tends to weaken the currency, but support risk assets like equities and bonds. That's why traders pay close attention to speeches, statements, and press conferences. Even a few changed words can shift the sentiment. When central banks make decisions, they often do so by a vote. Sometimes the vote is unanimous, but often it's not. And a split vote can tell us that not everyone is on the same page, which can reveal hesitation, internal conflict, or changing momentum. A vote split, leaning hawkish for instance, that means more members are favouring an interest rate hike, might suggest that a policy tightening is approaching, higher interest rates are ahead. On the other hand, if more members are voting to cut rates, the bank could be preparing to ease and cut interest rates. These internal shifts often precede official changes, so it's watching them that really gives traders an edge. So how can we use this in practice? Well, we can use it to track which central bank members are hawks and are doves. Pay attention to changes in their tone over time. And most importantly, monitor vote splits, because the balance of power often signals the next move before it happens. So, to sum it up, and you'll hear these doves and hawks referred to a lot in financial media and analysis reports. So remember, hawks push for interest rate hikes, tighter policy to fight inflation. Doves push for interest rate cuts, easier policy to support growth. Vote splits, on the other hand, they reveal internal pressure and shifting direction. By understanding these dynamics, you can anticipate shifts in monetary policy and trade ahead of the curve. One thing to note as well is that policy members can often shift from being dovish or hawkish. And in particular, you want to look for someone who has a reputation for being a hawk, say something dovish, and vice versa, someone who has a reputation for being a dove but says something hawkish. A recent example was in the Bank of England, where a very hawkish central bank member in 2025, Catherine Mann, voted for a bigger than expected interest rate cut, a greater cut than some of the more dovish members. This was taken as a surprise. You'll understand this more as you go through, and we will look at some examples of these vote splits in action.
Hawks versus doves. Hawks care about fighting inflation, doves care about boosting growth, and their tone shapes market expectations. It matters because a hawkish speech can strengthen the currency. A dovish one can lift stocks and weaken a currency. Traders watch every word for clues. Central banks vote on rate decisions. A split vote equals a disagreement and a possible pivot ahead. Unanimous votes show strong conviction among all the board members. Track who's hawkish or dovish. Watch for tone shifts and vote changes. Even subtle changes can lead to big moves. If there's a hawkish central bank member that suddenly starts making dovish comments, or vice versa, that's where the real opportunity lies.
Welcome to this session on quantitative easing and quantitative tightening, or QE and QT. In this module, we'll look at how central banks use these tools to stimulate or to cool the economy, and how they impact financial markets. So first of all, what is quantitative easing? QE, or quantitative easing, is when a central bank buys financial assets to inject money into the economy. It's typically used when interest rates are already near zero and can't be cut any further. The aim is to increase the money supply and bring down long-term borrowing costs. QE became a major tool after the 2008 global financial crisis. After the global financial crisis, rate cuts alone weren't enough to kickstart growth. There was a serious risk of deflation and prolonged stagnation. That's why central banks needed new tools, and that's where quantitative easing came in. It's what was called an unconventional monetary policy. So how does quantitative easing actually work? First of all, the central bank creates new electronic money. Then it uses that money to buy securities, mostly government bonds, but also mortgage-backed or corporate debt. The sellers, usually banks and funds, receive new reserves. Crucially, this is meant to encourage more lending, more spending, and more investment. Quantitative easing also helps lower long-term interest rates, and that is key. While central banks control short-term rates, long-term borrowing costs are set by the market. Buying long-dated bonds raises their prices and lowers their yields. That, in turn, makes loans cheaper for households and businesses, and these cheaper loans encourage more economic activity. A powerful example of quantitative easing in action was in March 2020, when COVID-19 rocked global markets. On March the 15th, the Fed launched a $700 billion QE package, but markets kept falling. So on March the 23rd, the Fed went further, pledging unlimited quantitative easing. That was the turning point. The S&P 500 bottomed and began to recover almost immediately. You see, because companies realized that longer-term debt was likely to be kept low, and that would encourage growth, and so markets could gain confidence in US stocks once again. So to summarize, quantitative easing is the process of money creation combined with asset purchases. It boosts reserves, lowers long-term yields, and supports borrowing and investment. Importantly, markets often react to expectations of quantitative easing before the central bank even acts. When the Bank of Japan launched a series of powerful quantitative easing processes, that significantly weakened the yen, and the dollar-yen was gaining on the Bank of Japan's quantitative easing program. You can look at that on the charts when the Bank of Japan used that process. Now let's take another look at something else. The opposite of quantitative easing is quantitative tightening, or QT. This is the process of shrinking the central bank's balance sheet, the opposite of QE. The goal is to remove excess liquidity from the system, and they usually do it gradually to avoid shocking markets. Now, during QE, when bonds mature, the central bank reinvests the proceeds. In quantitative tightening, they let those bonds mature without reinvestment, so no new money is created, and over time the balance sheet shrinks. This in turn tightens credit, pushes long-term yields higher, and can just hold back a bubbling economy. Now, quantitative tightening doesn't always mean selling, and it doesn't usually involve selling assets directly. Most of the time it's passive, just letting the existing bonds roll off and not renewing them. Direct selling is rare, far more aggressive. Still, even passive quantitative tightening has a significant impact on liquidity and risk sentiment. Central banks hold bonds of different maturities. During quantitative tightening, as those bonds mature, the central bank just doesn't reinvest. This gradually pulls money out of the system, tightening financial conditions. So, for instance, between 2017 and 2019, the Federal Reserve tried quantitative tightening by gradually shrinking its balance sheet. They reduced holdings by about $600 billion, and the result was that the S&P 500 dropped and the US dollar strengthened, you see. While other factors played a role, quantitative tightening was a key contributor. So keep in mind, when a central bank embarks upon quantitative easing, that should weaken the domestic currency. When it embarks upon quantitative tightening, that should strengthen the domestic currency. Because quantitative easing leads to looser conditions, quantitative tightening leads to tighter conditions. So here are the key points to remember. Quantitative easing adds liquidity and boosts markets. Quantitative tightening removes liquidity and can pressure risk assets. Both affect interest rates, currencies, equities, and credit. As traders and investors, tracking the size and direction of the central bank balance sheet is absolutely essential. Remember, if a central bank unexpectedly announces quantitative easing, watch for the currency to weaken. If a central bank unexpectedly announces quantitative tightening, look for the domestic currency to strengthen.
What is QE? QE equals central bank printing money to buy bonds. Goal: lower long-term rates to boost credit and lift markets. And it's used when cutting interest rates isn't enough. What is QT? QT, quantitative tightening, equals central bank letting bonds expire without reinvesting. The goal is to reduce liquidity, cool the economy. It's slower but powerful. Why it matters. QE supports stocks, credit and risk assets. QT does the opposite. Traders track these balance sheet moves like price catalysts. Key insights. Markets often react before the actual move. Even a slowdown in QE can be seen as tightening in some circumstances.
In this important lesson, we're going to unpack a crucial concept for understanding modern central bank, and that's policy normalization. What we're going to do is explore how it fits into broader monetary policy regimes and why it can move markets even when the policy doesn't fully shift. I'm going to show you the practicalities of how this works in reality. So you'll remember from earlier that central banks typically operate in one of three broad policy regimes. It's either expansionary, where they stimulate the economy, neutral, where conditions are balanced, and contractionary, where they're trying to slow things down, raise interest rates. And under normal conditions, policy tends to move gradually between these phases as the economy evolves. The bank might recognize that there needs to be some expansionary environments, interest rates are cut, and then it goes neutral as the economy gets hotter and inflation rises, and then it moves back into contractionary, interest rates rise again. And this sort of cycle goes on all the time. Now, in a crisis, though, there isn't that time for those slow transitions. If you think of the global financial crisis of 2008, 2009, or the COVID crisis, this gradual flow is kind of suddenly broken. And central banks turn to unconventional tools like quantitative easing and emergency lending programs. And the result is a monetary environment that no longer follows that normal script of expansionary, neutral, contractionary. So this is where normalization comes in. It's not like a full regime shift, but rather a transitional process. For example, a central bank may still be easing policy, but doing so at a slower pace. And normalization simply means moving back towards something more typical or sustainable. Now, normalization can take different forms. It might start with halting quantitative easing purchases, new ones for instance, then tapering the amount bought each month, just slowly reducing it. Eventually, the central bank might let maturing bonds roll off its balance sheet. So these are steps back towards normal. They're not necessarily tightening. So if you think about it from a market's point of view, the key isn't just what the central bank is doing. So it's not as simple as the central bank is using quantitative easing, therefore the currency must go down. The central bank is using quantitative tightening, therefore the currency must go up. From the market's point of view, it's all about how it's changing, right? So if markets reduce stimulus, say they've been stimulating the economy during COVID, but then they reduce that stimulus even modestly, the markets might take that as a hawkish signal because it suggests policy is becoming less easy, and that matters. So think of it rather than absolute levels, think of it as relative levels. Right, here's a very simple example. Let's say there's a central bank that's been buying 50 billion in bonds each month. They announce that they're going to reduce that to 25 billion bonds. So technically, right, they're still easing, or as it says here, let's use this example here. They've been doing quantitative easing at $100 billion per month, and they're going to reduce it to $50 billion per month. You see, they're still easing, but they're doing it at a slower rate. So markets might respond with a stronger currency, or maybe falling equity markets, just because they've changed back towards normalization. Now, the key to this is, was it unexpected? If this shift was suddenly unexpected, then you'd see a hawkish reaction because you'd suddenly see that relative shift impact. So this really matters for traders because markets respond to changes in direction, not just the level of policy. So just keep in mind that even if a central bank is still in an expansionary regime, reducing stimulus can affect prices. That's why understanding normalization helps prevent costly misinterpretation. Okay, this is something that becomes, intuitive as you really tune into the market narrative. So, for instance, say there was a central bank, it was, conducting a certain level of quantitative easing each month, and suddenly, unexpectedly, it reduced that quantitative easing. You'd know, oh, hang on, that's a surprise. We're moving back towards normalization, so the currency appreciates, even though you're technically in a quantitative easing environment. So it's important not to confuse normalization with a full-on regime change. So tapering doesn't always equal tightening. Slowing quantitative easing doesn't always mean that they're done stimulating. These subtle shifts, right, still move markets, especially if traders misread the direction. So just to be aware that normalization is a slightly different regime, and with so many crises, I think we had to have it in this course because it's a key skill to be aware of. So let's wrap up with a few big picture points, right? Normalization is a transition, usually in a time of crisis, but it's not a regime of its own. But it can feel like a regime change to markets, and it often marks a turning point in sentiment and positioning. So always ask, is policy getting easier, tighter, or just less extreme? That's the question that smart traders stay focused on. Remember, it's relative. So if a central bank has been tightening for years and years and years and then suddenly starts reducing it, then that's going to be perceived as an easing in policy, even though if it's technically still a tightening environment. I think that's the key thing to really focus on. Just always ask yourself, based on this current environment that I'm in now, is the policy getting easier? Is it getting tighter? Or is it just less extreme? And then that should be the lens within which to look at currencies. Now, we'll be looking at some of this in more detail as we go through, and it's something that will become intuitive to you in time. But just to be aware, with so many crises going on, we need to look at this policy normalization versus regime change lesson. Now, when you're starting out and trying to learn FX markets, I can't stress enough how important it is to go and read central bank statements yourself. As soon as a central bank has made a decision, you'll see all over the internet and financial media sound bites, snippets, whatever the market is focusing on, taken from that statement and regurgitated and repeated. The problem with this is when you're very experienced, you can deal with those little snippets and you can understand the significance. When you're still learning about the Forex markets, it makes much more sense if you go and read central bank statements. And also, the beauty of the central bank statements is that often central bank statements give a good overview of the global financial situation. So it's very useful for your learning as well. And also it's up to date. It shows you what central banks are, worried about, concerned about, how they're seeing the global financial situation. It can be very grounding for your analysis. And the other thing that is very important about these central bank meetings, and I will try and point it out as we go along through them, is how easy it is to see what the central bank is focusing on, and then how easy it is to see which risk event, which economic data point is going to be really hotly watched. So obviously this course is done at a certain time and place. And by the time you watch this course, there may be different governors of the banks. There may even be slightly different structures to the website, but the principles will remain the same. I will give you in a PDF sheet the links to all the world's largest central banks, so you can access them in your own time and simply. And I'll try and point out, some useful things on these websites as we go through, because sometimes, if I just said go and have a look at the website, it's easy to get lost, particularly at first. So I'll show you how to find the information that you need. All right, without further ado, we're going to start looking at, and of course we have to start with the world's most important central bank, which is the US Federal Reserve. The US dollar is the most traded currency in the world, comprising of around 70% of all transactions on a given day. And it's clear why the Federal Reserve is a very closely watched bank, which influences all other central banks. Think of the Federal Reserve as like the Pied Piper, playing the tune, and all the other banks follow along. Now, in the Federal Reserve, there is a group, and I'll just go over to the website now, called the FOMC. Now, the FOMC refers to the Federal Open Market Committee. And this group consists of 7 governors from the Federal Reserve Board and 5 presidents from the 12 district reserve banks. Now, at the time of making this video, the chair of the Federal Reserve is Jerome Powell. Now, Jerome Powell should be replaced by, early 2026, February, March 2026. So if you're watching this video after that time, there will be a new governor of the Federal Reserve. That won't matter because the work of the Federal Reserve will still go on. Now, the Federal Reserve website is here, right? And what you're looking for when you go onto the Federal Reserve is you want to click on monetary policy. That's what you want to look at. There's all sorts of things you can look at and explore and enjoy, but you want to look at this monetary policy aspect. And then there's a few things to point out. That is the statement. So that's the statement that is released when the interest rate decision is made. There's 8 Federal Reserve meetings a year. Now, 4 of those meetings have called the summary of economic projections. That's kind of what the Federal Reserve see about the path of inflation, path of growth, the path of GDP. It's kind of their forward projections, and markets pay a lot of attention to those summary of economic projections. You've probably heard about the dot plot, right? And I'll show you how to access all that. So this is the June meeting from 2025, time of making this course, and you can just click on there, and lo and behold, you see the statement. Now, this statement is short, and often the initial, the one statement that comes out is quick, it's to the point, and markets will focus on, even just small changes of wording, right? Even things like, the committee were prepared to adjust the stance of monetary policy appropriate if risk could emerge that could impede the attainment of the committee's goals. Right, the committee's assessments will take into account a wide range of information, including readings. Look at this. So you see at the end of the statement, in this instance, the Federal Reserve is telling you what they're looking at. Right, they're looking labour market conditions, inflation pressures, right, inflation expectations, and financial international developments. Now, at the time of making this, that's code for Trump's tariffs, right? Send the world into disarray, and that's what the Federal Reserve is saying. But this is domestic labour market conditions, the non-farm payrolls, ADP. What are the PMI labour conditions saying? Inflation pressures, inflation expectations, University of Michigan inflation expectations, right? What's happening here? Inflation pressures, CPI, PCE. Do you see straight away? So straight away, that's what the central bank is focusing on. That's what they're going to be using in order to make their decision, right? You see, this is how it works. Then, carrying on looking at the Federal Reserve, let's go back and also show these. You see, these are the projection materials, right? Projections materials there. And I won't labour this because I've shown you how to read the dot plot, but you can see they're looking what they're expecting, and you see how they're comparing it to the prior. And markets will sometimes move on these projections. So maybe the interest rate stays the same, but maybe these projections change quite a lot. Maybe they're all of a sudden seeing more growth or less growth. Maybe they're seeing higher inflation or less inflation. Remember what we've learned? Growth and inflation, growth and inflation. So that's what the Fed tell you. They tell you what they're thinking about, growth and inflation, and the market moves correspondingly. So you can see here that monetary policy page. And then on the minutes, if you notice, they're released like nearly a month after the statement. So in many senses, they can be old news. And sometimes markets will still move on the minutes. But you've got to remember that these minutes were from this date here. So sometimes if what could happen, say in the statement, they said, in the minutes, they expanded more on labour market conditions. And they said, well, if the headline non-farm payroll is above 130,000, we definitely won't need to cut rates, this year. And then if that says that in the minutes, and then there's been a jobs report since then all of a sudden markets might move. Very rarely have I taken a trade based on the minutes. Very rarely. So the most helpful information is the statement, get 8 a year, and then 4 of them have the projections material. So the next interest rate meeting, look at July 29 and 30, but there won't be the projections material for that print. The next one will be in September. So very, very helpful, simple, straightforward to use. And I can't stress enough, that is the most important central bank. Do check out the accompanying PDF. I'll have the website here, but now you know how to use it and how to access that data from the world's most important central bank.